Boeing is no longer a broken company, but it's also not a safe investment. The entire story now comes down to one thing: execution. Not demand, not competition, not even strategy. If Boeing delivers planes on time and scales production, the stock works. If it doesn't, even slightly, the whole thesis starts to crack. Boeing is slowly climbing out of a deep hole, but the progress is uneven. Revenue is improving, with commercial sales up around 13% and defense growing over 20%. But despite that growth, the company is still losing money in key segments, including a $563 million quarterly loss in commercial aviation. Margins are still weak and inconsistent, and cash flow is only expected to stabilize in 2026 before scaling meaningfully later. What changed is simple. Boeing is no longer collapsing, but it's not operating efficiently yet. The business is transitioning from survival mode to recovery mode, and that's a very different investment profile. At around $231 per share versus a fair value near $238, the stock is basically fully priced. That means you're not buying a turnaround early. You're paying for a successful turnaround. For this price to make sense, Boeing needs to ramp production, expand margins back into the double digits, and scale free cash flow toward approximately $10 billion over the next few years. If execution is even slightly delayed, there's no margin of safety. Boeing is trying to become a high-efficiency production machine again. The entire strategy revolves around scaling its core aircraft programs, especially the 737 MAX and 787, while using services and defense as stabilizers. The key shift is operational, not strategic. Fix manufacturing, increase output, restore margins. That's logical, but also fragile, because this isn't about innovation or demand. It's about doing the basics perfectly, at scale, in one of the most complex industries in the world. This is still a duopoly, but not an equal one. Airbus is currently winning in narrow-body aircraft, especially with the A320 family, while Boeing is trying to catch up after years of delays and quality issues. In defense, Boeing competes with Lockheed Martin and Northrop Grumman, but it has been less consistent due to cost overruns and fixed-price contract issues. Boeing's advantage is still real: high barriers to entry and massive backlog, but its execution has been weaker than peers. The biggest risk is simple: production doesn't scale fast enough. Boeing is still dealing with supply chain constraints, manufacturing complexity, and quality control issues. If suppliers can't keep up or defects reappear, delivery rates stall, and that directly hits revenue and margins. There's also balance sheet risk. The company is carrying over $50 billion in debt, limiting flexibility. And then there's execution risk on new programs like the 777X, where delays and cost overruns are common in this industry. This is not theoretical risk. This is exactly what has already gone wrong before. The upside is clear, but demanding. If Boeing successfully ramps 737 production, restores margins to mid-teens, and scales free cash flow toward $10 billion, the business becomes extremely powerful again. In that scenario, you're looking at a high-quality duopoly player with strong long-term demand, pricing power, and operating leverage. But everything depends on execution, not hope. Execution. This is no longer a turnaround story. It's an execution bet. Boeing is a high-quality business with real demand and strong industry positioning, but the stock already assumes things go right. That makes this a narrow-path investment. If you believe in flawless execution, it works. If you don't, there's no margin for error. You're not buying recovery anymore. You're buying perfection. I'll break down the next one soon. Subscribe if you want to stay ahead.